morning, ladies and gentlemen. Welcome to IPO Spotlight. We are going to discuss the business of iFinance, the recently closed IPO. Let us look at what the prognosis is for this company. Remember, it was open for subscription between 9th and 11th of February. Listing is on 16th of February. Issue size was somewhere like 1,010 crores, of which the fresh issue was 710 crores, and the pricing was between 122 to 129 actually. Joining us on the show is Mr. Sanjay Sharma, MD for iFinance. I is basically the Hindi income. Namaste, Mr. Sharma. A very warm welcome. Just wanted to discuss the broader structure of this business, which is for secured and unsecured loans for working capital and mortgage loans, which iFinance is deeply into. How do you see this underserved but huge market at this point of time? How has been the experience so far?
Namaskar, and thank you for having me on your channel. iFinance focuses primarily on the micro-scale unorganized businesses. These are the small manufacturers or small traders or small service sector companies across the length and breadth of India. We are there in 21 states, and the government estimated that there are 7 crore enterprises of this nature which are unorganized, which have not been lent to. And they generate almost 90% of the employment in the industrial sector. So it's quite an important segment to address. iFinance tries to address this by giving them working capital loans, and these are small loans of 1 lakh, 2 lakh rupees, typically against hypothecation of their machinery working assets. Or if they want a larger amount, let's say 4 or 5 lakhs or more for expanding their business, then we can probably provide that too, but against the mortgage of property. Here I would mention that it is a very different asset class, so it takes some understanding, and I think often people, when compare it across and say, is it secured, is it unsecured, we have to understand that it's first of all business lending, and it's not a consumption loan that's being given, so it behaves more like a loan to a business, stays quite stable, and the credit costs do not show tremendous amount of fluctuation.
Right. Mr. Sharma, you have an OFS of 300 crores and a fresh issue of 710 crores. 710, I'm presuming, is coming within the company. Now, what are the proceeds going to be utilized for? At the moment, you have about 10,400 staff. Is there a geographical expansion also in the pipeline?
Yeah, I think of the 1,010 crores, we received bids for 1,025 crores, so we have been oversubscribed, and in a difficult market, that is, we are very fortunate that there's been enough confidence reposed in our business model. The 710 crores that will come into the company is primarily something that will help us in terms of growth capital. Finance companies have to maintain a high level of credit capital adequacy ratio, and we tend to maintain a capital adequacy ratio of 25% or thereabouts. Given that capital adequacy ratio, this money will allow us to grow from our current 6,100 crore AUM to almost slightly more than double this size. So it will take us for the next 2-3 years before we look for further capital.
Okay. Mr. Sharma, at this point of time, what is the average borrowing cost for iFinance? And do you see that reducing a bit because of this 710 crore rupee infusion? If yes, to what level?
Sure. I think it's an excellent question. Today, we raise money, incremental money is raised at about 10.6% cost. And this is when we deliver a product which is actually considered to be priority sector lending by Reserve Bank of India. When you lend to micro-scale MSMEs, it is priority sector lending. So we have typically been seeing falling in our cost of borrowing. A year back, it used to be 11.3%. Today, incremental is at 10.6, as I mentioned. And this lowering of cost ultimately helps us keep our NIMs steady, and I think keep our business profitable. As interest rates drop, our plan is that we will at some stage start passing it back to the customer whenever it is sizable in amount to pass on. For our customers, it's not the price that attracts them to our product, it is the availability of finance, which earlier they could not get from any of the banks or NBFCs. So while pricing does have a small part to play here, it's making available of credit, which is the bigger challenge which we have addressed.
Right. Obviously, if credit is available, that's a big blessing. If credit is available at an affordable cost, that's even a bigger one.
Yes.
If you could just share with us your average lending rate across the book.
Yeah. So I think our average rates vary, and while in mortgage we can provide mortgage-based business loans, we can provide a rate which could be anywhere from 14% going up to about 23-24%, depending on the risk that we perceive. And for hypothecation, the rates are a little higher, and they can be between 26 to 28.5%. I would like to mention that being
how about
a small ticket
loans? What are they? Yes.
Yeah, so I was saying that being a small ticket loan, the costs of origination, which are as good as costs of originating a 5 or 10 lakh rupee loan, have to be defrayed over a smaller tenor and a smaller amount. And therefore, it's always a challenge. How do you automate enough to make sure that costs are within reason? And the price point that I mentioned is something that our customers really are very excited about, because their alternatives are to look for unorganized money, which often comes at a significantly higher credit cost.
Yes. Okay. What's your average loan size, Mr. Sharma?
Yeah, so the average loan size is about 1.5 lakhs. And this is, think of it like a business which has a turnover of between 3 lakhs to about 8 lakhs in a month. For them, 1.5 lakhs is a substantial injection into their ability to do more business. Many of our customers who started off some years back with 3 or 4 employees today have 20 employees. So I think we can see that transformation happening in many of these micro enterprises because funds have finally been made available to them.
This I agree. We've just discussed this a little later, that if you can get capital at an affordable cost, it becomes a catalyst for growth. And I'm sure you see many wonderful examples of how entrepreneurs in tier 3, 4, 5 cities in India are basically flourishing because the access of capital is now predictable, available readily, and of course at an affordable rate. One more question that I have in mind at this point of time, Mr. Sharma, is the interest rate cycle. Seems that the Reserve Bank of India is out of ammunition, if I may use the word, in terms of cutting borrowing costs. Where do you stand on the interest rate cycle at this point of time, sir?
I think the interest rate cycle for us is benign. We can see that interest rates for us, incremental borrowing rates are falling. And it's not just because of the cost of or the pricing that the banks have given in conjunction with RBI's stance, but it's also the fact that we are getting bigger, larger, better organized, and our ability to therefore, our bargaining position is better with banks compared to, let's say, 2 or 3 years back. And that has helped bring the price down. So if you ask me, we find that the price drop that we are seeing will continue. And we also continue to pass some of it to, especially for repeat customers, for people who come and take a repeat loan, we often give them a rate which is about 1.5 to 2% lower than the standard rates that I mentioned. So much of this benefit is passed back to the customer with the thought that if they do well and they pay us well, then we should reward them.
Okay, in terms of geographic reach and current exposure to the balance sheet, where is the bulk of revenue, loan growth and profit coming from for iFinance?
Yeah. iFinance is a company that has diversified its geographies, and we are present in 18 states and 3 union territories, and we are almost equally strong in the north, in the south, in the east, and in the west regions. Even if you look at our branches, you'll find almost a equal distribution in each of the regions. So although we started from Delhi as a first branch, but we have made an attempt to make sure that we are in multiple states. This diversification helps us in ensuring that there's no volatility in our portfolio if there is a problem in any one or two states. So I think that has been the approach. So therefore, the answer to your question would be that the growth will come from multiple regions, not one specific region, and there's adequate and more demand for our product. As I said, the estimate is that there are about 7 crore such enterprises. Our current active base is only about 6 lakh customers. So a lot of unaddressed market still remains. A lot of work still stays ahead for us. We started this with the thought that we want to transform micro enterprises which are unorganized, and I think our journey has started well, but it is still not a point where we would say that we have completed that entire mission.
Okay. Mr. Sharma, my final set of questions to you. What has been the trend over the last 2 odd years for gross and net NPAs? Where do they stand as a percentage of outstanding loan?
Yeah, that is a key question and an excellent question. Often, and I mentioned that, our asset class has to be understood well before one can really analyze and comment. Because the loan is only a 2-year tenured loan, the credit cost overall looks high. Because take example that if there are 100 customers and 5 of them will go bad, then if my tenure is 2 years, then that 5% of customers going bad after 2 years looks like 2.5% or 3% of credit cost. Whereas if I had a 5-year tenured product, maybe a mortgage-based 5-year tenured product, my cost would get divided over 5 years and it look as if it is only 1% or 1.2%. So I think it's important to see that where is your level and how much have you gone up or down that level. So from 3.5%, which is the typical credit cost that we expect, we have seen our credit cost did go up. And last year was a year when over-lending was rampant in the markets. Many players came in at that time and did lend. It has impacted our customers. Our credit cost last year was 5.15%. And in good years, we have seen below 3.5. So if you look at the volatility of the credit cost, that from 3.5, how much have we risen versus any other asset class, if it's a mortgage loan, then a mortgage, how much percentage has it grown? You'll find that we are in a better situation. Also, another marker there, Mr. Bhatnagar, is that we have seen a delivery of 3.5% return on assets, even in last year when our credit cost was 5.15%. So it has not, in a way, changed the profitability of the business. And the good news is that for the last 3 quarters, we have consistently seen the credit costs come down. And we do believe that the worst part of that cycle is over. And the new customers who are coming in, when we look at early signs of delinquency, they show similar trends as was in the good years of the past.
Take care. On that very hopeful note, Mr. Sharma, is wishing you the very best for the listing on February 16th. It's one of the most competitive industries that you are in, and in a segment that's hungry for growth and hungry for capital. Here's wishing you all the best.
Thank you so much. Thank you for having me here.
That, ladies and gentlemen, was Mr. Sanjay Sharma, MD at iFinance, which is about to get listed on February 16th. Thank you for watching us. Have a nice day.